And this question came in about straddles and strangles for earnings plays. And the specific question that came in from Marcia was, what are your thoughts on straddles for earnings trades? Looking at a low volatility of 70% and lower at the 70 or higher delta of each option strike with half a week to expiration. Or that would be a strangle, actually. We're going to talk about that in one moment. Or maybe at the money strikes for both put and call options, if deep in the money strikes and in the money long strangle is what she was referring to initially, are too expensive for her personal account to look at risk management. All right. First, some related content you might want to take a look at. On the Long Straddle and Long Strangle homepage on Power Options, those of you in a trial or subscribers, you have access to Ernie's video, Introduction to Straddles. Just go to the Long Straddle page or the Long Strangle homepage. The direct link, of course, is just powerop.com/longstraddlevideo.asp. I don't think you have to be logged in to access that play. It's about 35, 40 minutes. It's an introduction to straddle structure and what one might look for. On YouTube, we have some previous videos, and don't you worry, Marcia, we're going to cover your topic as well right here. But there's some other videos you might want to check out. If you go to our YouTube channel, just do a basic search, Straddles for Earnings. And the first one you might see is a little about Straddles for Earnings. It's a 26-minute video which answers 4 questions directly, similar to yours. Which is best, straddles or strangles, or long or short? How far in advance of earnings should we place the trade? How far out in expiration? Same week, following week. And how do we trade straddles or strangles? So there's some other insight there that's good. There was a follow-up video to that, which is less than 9 minutes long. It was the brief follow-up, questions relating to, isn't there a risk of losing the whole amount on those earning straddles? Absolutely. In both straddles and strangles, you can lose 100% of what you invest in the position. And is it better to try to leg in, to pick one side or the other, wait for it to increase 30 or 40%, than buy the other option to have a much lower risk? And that's about a 4-minute discussion. We go through that as well. But let's take a look. We're talking about here potentially buying a call and buying a put at the same strike price. That would be a V-shaped long straddle position to play earnings. This afternoon at 3:22, here are a couple positions that have earnings dates coming up next week and the potentials for straddles that sort of actually matched Marcia's criteria. Implied volatility was less than 0.7. And this is the straddle, so the delta rule she was looking for didn't apply. But let's go back. The pros and cons of each approach. And in the money long strangle, with Baidu's earnings coming out next week and looking for the February 18th expiration cycle, an ITM long strangle buying the in the money 155 call with Baidu at 161.19 and buying the 170 put. Both deltas are in her range above 0.72, and the implied volatilities, of course, are in the lower range she was looking for, less than 0.70 as well. These options are expensive. They have both intrinsic value and some time value by the inflated implied volatility as well. Buying the two in-the-money options, an in-the-money long strangle, is going to be a high cost. You have to pay for that intrinsic value and for whatever time value is there in those options, or what we call extrinsic value. The in-the-money strangle for Baidu, almost directly at the midpoint, maybe the 167.50 was closer to it, but it didn't have the delta I don't think that she wanted at the time I ran the search. It comes with a price of $19.35. One contract would be $1,935. However, since this is the in-the-money put, if the stock was at 165, this would still retain 5 points of value. And the 155 call, if the stock was at 165, would have 10. The maximum risk here is only 435, because if it's between the strike prices after that earnings event, the value between what's remaining intrinsically between the put and the call would still be equal to $15 in either direction. So the most you can lose is 435. What's important here, though, is in this structure with the strangle, Although we have a relatively low risk of $435, infinite potential profit in either direction, the break even, the lower break even is 150.65, which means we need a drop of 1054 or 6.5% at earnings to get to that lower break even. The upper break even's at 174.35. So we need a move of $13.16 because maybe it's a little bit skewed using the 170 instead of the 167.50 in this case, but that would be a gain of 8.2% in order to get to the upper break even. So pretty significant moves needed in both cases, not out of bounds for what one might expect at earnings. But let's move on and take a look at maybe the comparison. Another approach, which is a parity trade, has almost the same risk-reward ratio in the sense of the upper to lower break-evens, and the risk that's taken is just flipping those two. In other words, instead of buying the in-the-money strangle for the higher price, flipping them and buying the out-of-the-money 155 put and the out-of-the-money 170 call puts us at a total net debit of 441, similar to the 435 risk we saw with the in-the-money strangle, this short of time period to expiration, as you were mentioning. The max risk is 441, very similar to the maximum loss. However, in this case, if the stock stays between the strikes, there is no intrinsic value on the out-of-the-money call and the 155 out-of-the-money put. They just both go to zero very quickly. Implied volatility is probably going to decline a little bit. The options are going to go to zero after the event, or close to it if the stock's between those strikes, so you lose the full 441. The upper and lower break-evens are pretty much the same. We need to see a movement of 1060 or 6.8% to the downside in order to see a profit to hit the break-even. We need a movement of $13.32 or 8.2% to reach that upper break-even on the position. Almost identical to the in-the-money strangle. They're going to have similar implied volatilities. All we did is flip the deltas. Okay? So if cost is a concern with the in-the-money strangle positions, Marcia, remember the out-of-the-money will have almost the same exact risk-reward profile. Okay? You still need those movements to get to the upper and lower break-even that are pretty much identical to what you'd need with the in-the-money long strangle. What about that straddle position? Okay? Straddle position that we saw from that basic search, we could do the 160, but I think the 162.50 is closer to right at the money right now. It's about $1.10 off instead of $1.40. It is a little bit more skewed to one side, meaning depending on where you can get your V, because we're not exactly at the stock price, you might have a lower break even to one side or the other if we're skewed in that direction. Here we're sort of skewed away for the put side. We have a debit of $9.95, and of course, we could lose that full amount, the $9.95, double of what we saw with the other two strangles, the in-the-money strangle or the out-of-the-money strangle. In order to lose the full amount, though, the stock has to be trading exactly at 162.50 after the earnings event and as we get closer to expiration. If it's down here at 160, we'll get $250 back, but we're still looking at a loss of $740 in this case. The other option just expires worthless. So what do we have here? We have a different structure that's a V profit and loss chart where we only need an $8.89 move or 5.5% to get to the lower break even of 152.55. We only need a move of 6.8%, not 8.2%, to get back to the upper break even of 172.45. We positioned our call and put right around the current stock price. Yes, we're paying a higher amount, but that helps lower the upper break even and the lower break even as well. Okay, so let's table that real quick. Let's get a better view here of what we're talking about as a rough comparison. In the money strangle, and this is just one example, but the conclusions are going to be the same. Out of pocket, paying the intrinsic and the extrinsic value going into the earnings next week with the February 18th expiration, The in-the-money long strangle had a cost out of pocket of $19.35. However, if the stock ended up between the strike prices, we had a 15-point strike difference between 155 and 170, so we can get 15 back. The max we're losing is 435. Needed about a 6.5% move to the downside to hit break even. Not the profit you're expecting, that's to hit break even, because we know we're going to lose most, if not all, of the extrinsic value in these positions after the event happens. And we need an 8.2% movement, or $13 in the case of Baidu, to get to the upper break even playing this long earnings position. On the other side, the out of the money strangle, no intrinsic value, just paying the time value. Well, that's at 441, pretty close to the same risk that we would have had with the in the money long strangle position, but at less cost. Again, a 6.8%, roughly about the same to hit that lower break-even mark with the out of the money strangle, and an 8.2% increase, exactly the same, in order to hit the upper break-even on this position. I was doing this in real time, so the stock was fluctuating between 160.74 and 161.19, so that's why we're still seeing 8.2% relatively with just a 16-cent difference, okay? But it's still about the same move. That's what you expect. That's what you're going to need to expect in a movement to profit on these strangle positions playing the earnings play, 7, 9, 10% to get to the profits you want. That also depends on the stock. Let's talk about the straddle. Same call strike, same put strike, same expiration. Cost $9.95, which is your maximum risk. If and only if the stock is trading right at the strike prices, right after the expiration, if it's hovering right at 162.50, you'll probably only be able to get 10 cents for both of those options. You're pretty much near the maximum loss. That does give us an advantage of needing a lower movement to the lower break even, but we still need a 5.5% move to get to break even, not to profit, but just essentially to break even, and a little bit less on the upside, only a 6.8% movement or $11 to hit break even with the at the money straddle position. The rough conclusion and comparison here, Marcia, of course, is the strangles offer a lower maximum risk. Whether you're going out of the money or the parity trade that's in the money, you're going to have a lower risk than the straddle. The in the money one will cost more out of pocket, but it's essentially a parity trade to the out of the money strangle. The at the money straddle position offers the higher risk. Hey, ATM bell curve, both of those two options, we're buying right at the money, are going to have the highest time value of all the options on that chain. That's why we're almost double the risk, in addition to the increased implied volatility likely with earnings coming up in a week or so. But it needs the lowest movements to get to break even on the upside and on the downside as well. Now, as I mentioned, in either structure, in the money strangle, out of the money long strangle, at the money long straddle, 7 to 10% movement is really the expectation to get the returns. And I mean, even on 30, 40, or 50% returns that you might be trying to target. Now, we have seen some big moves recently, of course, and we all know what we're talking about. On February 2nd, Facebook's down 85.24, Meta is down 85.24 or 26.4% due to loss of revenue and some other factors as well. Apple had a very strong earnings, and they were only up about 6.8%. Not too bad, but it's not really the profit you're trying to expect with this position. You're trying to, I don't want to say you, Marcia, specifically, but when we're trying to do this, we're hoping for a big swing on one of these stocks to see a good, maybe 80, 90% return, maybe even more. We're going to take a look at that in a moment. But a lot of these positions, even something like Apple, if it had only moved 4 or 5%, a straddle or strangle position might have been near the full loss. You really need closer to that 7, 8, 10% movement to start to see the returns you're kind of hoping to get with this approach. Now, would either have met our criteria? Let's go back to January 24th at a basic search on power options, looking just against Facebook and Apple. In this case, we are looking at straddle positions, the at the money long straddle. for the expirations. Remember, Apple was on January 28th, Facebook was on February 2nd. I think I said that wrong on the previous slide, and I apologize. You can see here that the positions that would have matched different at-the-money straddles, Facebook was at 308.71 on January 24th. The 310 straddle and the 305, very similar costs. Both are right at the money, 2 points out of the money here, 3 points and 70 cents out of the money here. Both have relatively the same cost, and both amounted to a very high percent return on the position. 26% movement. You're going to see 150, 190, 200% returns. How often do you come across those stocks ahead of time that have that big surprise that you weren't expecting for a 26% movement? That's sort of the trade-off here. Apple, very interesting case. The stock was at 161.62. 90 cents up, the 162.5 strike for 4 days out for January 28th, because that's when Apple's earnings were. We had to go out to February 4th from January 24th for the Facebook positions. This is 90 cents in the money or out of the money, however you want to look at it, with the stock at 161. Had a cost basis of 893. And with that 6.8% movement, the value of those options on January 28th towards the close, it was only about 783 at midpoint. It was a loss of 12%, even though you had a 6.8% movement. If we skewed it to the upside, meaning we put the call slightly in the money, which you'd still consider at the money, but this would have been a slightly lower V profit and loss chart where the 162.50 out of the money call would have been here. This movement resulted in a 20% return. Only a 20% return, a profit, what is that? Of roughly $1.70 on 863 for a 20% return with a 6.8% movement to the upside. Okay, the Apple return was lower because naturally we didn't see the movement that we wanted. But this is also to illustrate, if you're trying to hope or for a trading plan of using these strategies to play earnings of 40, 50, 60% returns on your straddles or strangles, you're talking a movement of 9, 8% or higher to get to the desired returns. And yes, if you have a blowout, you'll have huge expected returns, but they're more difficult to come by. Now, in comparison, the out-of-the-money strangle positions, same date, January 24th. With Facebook at 308.71, going to February 4th expiration, because remember, earnings were on February 2nd, the 320, 12 points, 11 points out of the money, and the 295, roughly about 13 points out of the money, had a debit of 15.13. Why am I using these? Because these were the ones that had the delta of 0.30, which would be the parity view of going with the in-the-money strangle of Marcia's goal of a delta of around 0.70. We just would have flipped it. I would have done the 295 in-the-money call and the 320 in-the-money put. The return would have been about the same in this case. It's a much higher return, remember, because both of these options that went in the money, whether we were at that 310 or 305 straddle for Facebook when it had its 26% move, or here with the 295 put, we paid less for the strangle, $15 versus $26 and $25 for the straddle position we just saw on the previous page. So the return goes up slightly higher. Both options, all three options, of those put options went right to intrinsic value, and the calls went exactly to zero, as you'd expect. So 189, 187% return versus 282.9 with those deltas that Marcia was looking for. The Apple position, only a 3.8% profit with a 6.8% move on the strangle. 514 debit, closing price was around 533 for the spread as it got closer to close, of course, on 128. So it was only a 3.8% return. Now, first thing in the morning, if it gapped up a little bit higher, if it went to 171 or 172, this might have been 8, 9, 10% return. That's highly possible. We're just can do what we do with the closed data here in this situation. The in-the-money long strangles that I looked at, I just built them with the option chain and took a look at them. They were the similar returns. In other words, if you were to reverse this, as I mentioned, bought the in-the-money 295 call, bought the 320 in the money put with the stock at 308. The debit, of course, much higher, but the return at the end was the same amount. It was a 281.7. The in the money strangle for the Apple position, the 165, if we would have bought the in the money, 165 put and bought the 157.5 in the money call, the debit went up to about $12. No, it was $9.60, I think. And the return was about the same. I think it was 3.6%, if I remember correctly, off of the investment on that position. So that's the kind of returns you're expecting. Again, it's interesting, isn't it, that one of the straddles that we skewed to the bullish side, because you can't get right at the 160, 160 strike, one of the ones on the bullish side, of course, was a profit of about 12%. The other was a loss, and they even out to about the gain that you'd have here with the strangle position with that movement of only 5 or 6%. Again, let's just take a look at that. What I'm talking about here is 19.8. Now it's a little bit more versus a loss of 12.3. Here, that strangle was 3.8%. The strangles have the lower cost, 5.15 versus 8.63 and 8.93, 15.13 versus 25 and 26 for the at the money straddle. Risks are about the same, but depending on which strike prices you chose, of course. I mean, what I mean by that is the in the money strangle for either one of these had the same monetary risk, but had the higher prices because you have to pay both. Overall, again, review, the strangles offer the lower max risk, though the in the money strangle has the higher debit out of pocket at first, but it has about the same risk. The long straddle, same strike prices at the money, offers higher risk, but needs lower movements to get to break even. But you see, there even in here is a chance of getting the move that we want. But if we had to skew it accidentally one direction or the other, we were actually at a loss on the position. Too far out of the money here on the call with that higher strike price actually resulted in sort of a loss on the position. We're going slightly below it. If we knew ahead of time, we had a slightly bullish expectation, a slight profit on the trade as well. So again, review that content there. I think this video with the first 4 questions flushes out some more of this detail related to how far in advance of earnings should we place the trade, shows different examples, my apologies. How far is the expiration? How do we, trade those with some other thoughts there as well? Of course, this one will be posted also. It's being recorded, so don't worry about that. But you can take a look at those. Remember, go to Power Options on YouTube, Straddles for Earnings. You can take a look at those too while you're waiting for this presentation to be posted. As always, major disclaimer. Earnings, straddles, and strangles, long or short, which we didn't talk about today, selling the call and the put, which would have probably really hurt you on Facebook. It would have been, pretty big loss actually, but maybe not as much on Apple. But again, they carry high risk into the unknown event going forward. Even if they beat their earnings and you are bullish, something happens where they say, but even though we missed slightly here, our outlook for the next quarter is fine, and the stock only moves 1 or 2%. If you're short, that looks great. If you're long, you've lost 90% of what you put in. Long straddles and strangles discussed right now can lose 100% of what you invest in either position. Known risk is not necessarily low risk if you're not disciplined. One should not apply this approach with a significant portion of your portfolio. Each long straddle or long strangle position that you're trading for an earnings play in your portfolio shouldn't probably be more than 2 or 3%. It's like a lottery ticket almost. It's not an investing strategy that you should be using with obviously 40 or 50% of what you have to trade in the market. Okay. Options involve risk, may not be suitable for all investors. Now, past results shown are no guarantee of future returns. Each stock is going to behave differently around earnings, and each stock is going to behave differently quarter to quarter. Next quarter, for example, based on what happened with Facebook in this quarter, it could be possible that 2 weeks or 3 weeks before that next earnings event in 2.5, 3 months, the implied volatilities of Facebook options could be double because of the memory of what happened this quarter, which is not normally what it is going to an earnings cycle. Every earnings cycle is going to be different based on the stock itself, previous announcements, and specifically the most recent one, current market conditions and current market outlook, and what other stocks have been doing with the earnings if they came out before it as well. All right, Marcia, so I hope that gives you some concepts, some comparisons to consider, some ideas to consider in relation to the straddles versus strangles and what to look for as well. And a little bit, not today, but what I might add on to this feature or as a follow-up is setting up the Power Options tools to find the out-of-the-money strangles and the straddles with the type of settings that we were just discussing.